Hey, party people, welcome to this week's Money News in Human Words. And well, look, once again, there's a bunch of stuff going on this week. The main thing that probably should be on investors' minds at the moment is the share market tanking, led by the US off the back of their unemployment and wage data, which, to be honest, it seems pretty strange because both of those data points are positive. Unemployment in the US is down from 3.7 to 3.5%. Inflation still sitting at 8.3%. Wages grew 0.3% to 5% annualized rate. So the wage growth is actually slowing. And it's also weird because you'd think that that's actually a good thing. Unemployment's going down, wage growth is slowing down, and the governments want the wage growth to slow down because if the wages are growing too fast, it means that then inflation continues further. But when this data was released, the share market went down by almost 4% in the US, which is a massive one-day loss. And it's all because of the fear that the economy will keep performing too well. And then as a result, the Federal Reserve, their central bank over in the US, will need to continue to raise their interest rates further, which could eventually slow down the economy. So you'd be forgiven for thinking that it seems a little bit sort of backwards, that you're getting good economic data, but the market's tanking as a result. But with the interest rates in the US up 2.25% in just the last 5 months, the economy is still firing. It's still going strong. The news here is actually good. It's just the fear of it getting bad that's hurting the share market and hurting investors at the moment. The other thing that's a little bit concerning that's come out in the news over the last week is this talk of winding back the stage 3 tax cuts increasing in Australia. Albo apparently hasn't given the green light to winding back these the Labor election promise of continuing with the legislated stage 3 tax cuts, which are due to benefit basically anyone that earns more than $45,000, all kicking in from July of 2024. But he has given the green light to floating the idea of winding back these tax cuts. So the Treasurer, Jim Chalmers, has come out and spoken about it in a few different speeches. They've said that they're not necessarily firmly planning to do anything, but they are considering all their options and looking to balance the budget. They're basically saying that debt repayments, the NDIS, defense, and these areas of government spending, they need to continue to increase. And because there's this big budget deficit, they need to be, prudent and look at balancing the economy where they can. These tax cuts cost a significant amount to the budget bottom line. So they're talking about them being on the chopping block. But the thing is, with this spending, there's none of them that have actually changed that much. It's all of the things that we're seeing now were broadly forecast when these tax cuts were talked about. The only slight change is around defense, where they're talking about, given the tensions, Russia, Ukraine, China, Taiwan, that defense spending is more important. And I agree, but there's not a lot that's really changed. And it seems that they're potentially looking to wind back on this promise, which would benefit millions of taxpayers, and particularly, obviously, for anyone earning more than $45,000. But the more you earn, the more benefit that's there. So for someone earning $200,000, the tax savings about $10,000 per year. So pretty significant, and also a nice equalization of the tax rates. I know it benefits the higher income end of the spectrum more, but given what we see with the planning work and the challenges of living well in Australia, even if you do earn a good income, you got the higher income earners paying significant amounts of tax. So any tax savings there is going to help them ultimately get ahead more. Now, given that we're currently running a pretty significant budget surplus, even though the forecast is to run a deficit, but we've seen $10 billion government surplus over the last 6-month period, it is a little bit hard to swallow. So write an email, leave Dr. Chalmers a Google review or something, and fingers crossed that they don't end up peeling them back too far or at all. Next piece in some welcome news, that's the one of the chief investment officers from Australia's biggest super fund has come out in the news saying that he feels that Australia is well placed to beat the economic downturn that we're seeing around the globe at the moment. Basically, Australian Super's CIO that manages $260 billion has come out saying that we are in a pretty strong position. One of the things that he cited in this in his comments was that the Australian share market is down about 11% at the moment, but it's less than half of that of the US market, where the S&P 500 is down 25%. The NASDAQ is down over 30% at the moment. And the comments are quite interesting. One thing, and I think there's a really, really interesting lesson there for investors, is he said that the bear market, so the downward market essentially, will continue until people have almost basically lost hope of a recovery. He said you basically need to get to the stage where investors are feeling despair rather than the downturn being an opportunity to buy the dip. He said that the psychology of buying the dip starts to disappear towards the end of the bear market, and feels like at the moment there's a lot of people saying, oh yeah, there's opportunity there, buying into the market in the dip. And this is something that I'm seeing. Personally, I'm buying. A lot of our clients are investing at the moment. And I think that, downturns are the opportunity to really make money. So smart investors that have solid game plans are doing well to invest today. Now, markets could continue down, but reading through the lines there, that the lesson is that being smart when the markets are down will make you money when there's a recovery. Now, that could be a couple of years away, but buying in when we're seeing better value now means that you're going to be buying in at a lower price point than when the recovery actually happens. So I think for investors, it's obviously super, super important to have a rock solid game plan around your investing when the market is down. But clearly the opportunity is out there, and fingers crossed these predictions are right, and we can avoid facing the same sort of economic disruption that we're seeing around the world. Another piece of welcome news talking about the property market softening, which could be over as early as the first quarter of next year. Tim Lawless is the director of CoreLogic, who are a powerhouse in property market data. He said that he felt that the Australian housing market correction would likely bottom out in the first quarter of 2023, and then we'd see a swift recovery after the rate of house price decline eased slightly in September. So we've been seeing declines over the last little while, led by the Sydney market in particular, but Victoria as well. But that rate of decline is actually slowing. Now, the data suggests, and Tim mentioned in his comments, that it's probably unlikely to be quick enough to stop the Melbourne market from reversing all of the gains it made during the pandemic, because Melbourne property values are up by 17.3% during the pandemic. They've only got another 4% to fall to return to the levels that we saw in early 2020, which seems highly likely based on the data that we're seeing at the moment. Now, Mr. Lawless come out saying that he would be very surprised if it didn't happen, because he feels like there's another 4% to fall in the market from across most capital cities, not just Melbourne, based on the uncertainty that's in the market, interest rates, and all of those sorts of things. But when we look across the country, we saw that the house price actually increased at a higher rate. And so there is still a lot of markets where, even though the property market has softened, prices are still above where they were pre-pandemic. Now, Mr. Lawler said that even though there was that initial shock factor of rates going up, the buyers and sellers know that that this will continue, but conditions are decent for now. Basically, 6 months ago, we're seeing a market that was skewed towards sellers, whereas now it's getting a bit more of an even playing field and tipping more in the face of buyers. He said that he firmly believes that there will be, regardless of when it comes, that there will be a V-shaped recovery. That means a quick, sharp recovery. And this is one of the things that we're talking a lot to our clients about at the moment, where If property makes sense, we know that the property market probably is going to keep going down in the shorter term. But if it makes sense for you over the longer term, if you keep waiting until the uncertainty is gone, you might have missed the recovery, and then you end up just paying a whole bunch more for essentially for the same property. The last piece from this week was around super funds being forced to cut the value of their unlisted assets. And basically, unlisted assets are things like private equity investments, infrastructure investments, things that aren't traded like shares, which are traded actively on the share market day in and day out. Now, the share and property markets around the world are down, but because these unlisted assets are only valued, when someone decides to revalue them, essentially, they're still showing on the books of a lot of super funds and a lot of investment funds at being worth the same amount. Now, these unlisted investments make up around 12% of the $3.4 trillion Australian super fund market. So we're talking about massive, massive dollars. And there's pretty lax rules around how super funds need to revalue their assets, or in fact, there were quite lax rules, but they've tightened those up. Although the new rule changes are filtering through now. It's what we've seen is that in the last turn, and the reason why those rules were tightened up is that a lot of super fund trustees and executives switched some of their retirement savings out of unlisted assets in 2020 before the investments were revalued to reflect the big sell-off that we saw during the pandemic. Now, ASIC, the Australian Securities and Investment Commission, took a close look at that, and they ended up not pursuing legal action around the trustees and executives, but they cited these lax arrangements around managing conflicts of interest. So the super funds have promised to lift their game, essentially, and bringing in measures to stop inappropriate trading from the people in their teams. Now, these rules have only been tightened in the recent past, so it'll be interesting to see in the current correction, where we know that these unlisted assets will be revalued and revalued down, to see what actually happens with the super funds. It's likely that the super funds are probably going to tighten the screws on how they process those switches if they're hit with an avalanche of requests from their members. Now, in my view, you probably don't need these sorts of unlisted investments. The super funds use them because they've got so much money to manage that it's like they sort of it's challenging to invest just into share type investments, whereas investing billions of dollars in one go into a toll road or a skyscraper or a building can be simpler. There is some potential for returns over time, although there's probably no measurable, firm data to say that it does necessarily perform better than the share market. But given the lack of liquidity and these sorts of issues and the stress and concern that can come with it, I just sort of question that whether, is this something that people really need? And for me, the answer is no. These funds definitely have a bunch of more fees than what you'd get from a share type investment or any other sort of standard super or otherwise investment option. And I just don't think that sort of stuff is what you need, given that you can get such strong performance with just regular share market investments alone. Guys, that's it for me for this week. I hope you enjoyed it. Stay safe out there, and I'll catch you next time.